Okay, so this is the panel about financial modeling, a topic seldom discussed and very little understood. Because how do you answer the question, how much money should you raise? Most people say, well, let's raise X, it'll good for a year. Good for a year? How do you know that's the right answer? So financial modeling is super important to know what are the financial needs. Does this business even make sense? Should you even be diving into it? So everybody has to do a financial modeling to able to answer those questions and how much money to raise. So this is the panelist. Let's hear from each one of them, and then we can get deeper into that. Sure. So we'll start with Betty Kayton. Betty, tell us, who are you?
Hi, I'm Betty Kayton. I'm what's called a fractional CFO, or if you want to be very unclassy, a rent-a-CFO. And what that means is a company that's large enough that needs some complex needs beyond bookkeeping, but can't afford or doesn't want a full-time person yet. So I've done some companies you never heard of, like Dropbox, I was the fourth person, Leapfrog Toys, number 7, Dropcam, number 7 also, and a whole bunch you never heard of. So I love just working in the 0 to something stage. I call it 3 guys and a dog, and I'm the dog.
Hello, everybody. So I started in this valley 25 years ago in the semiconductor business, and I ran the national and then international sales and operations, and ultimately as the managing director. After that, I did lots of software here, the usual enterprise software and IoT. I'm now working in coaching at right now an accelerator at Founder Space, and I do this in Asia and Europe and here. I'm also in a startup that asked me to join. I've helped launch a lot of products. So that's my background. That's why I know what the budgets look like, because I make the budgets and then spend the budgets and get the results.
Hi, everyone. Good morning. It's a real privilege to be here. Thank you, Professor Zafar. My company is Oorjan. We are based out of India. I'm actually here as a part of delegation where top 10 women entrepreneurs in India were selected by the Indian government and Anita Borg Foundation out of about 350 of us to represent, to come see the valley. I have also lived here for about 8-9 years, so it was to some extent coming back. My company is about 2 years old now. We are in the rooftop solar space for homes and businesses in India, which is a market which is kind of doubling every year for the last 2-3 years, and I don't see that growth stopping for the next at least 5. So we've spent some time figuring out what kind of money to raise, who to raise from, if we actually need to raise money. So I'd be happy to share some of my learnings from that side. Thank you.
Let me start by, while you're thinking about which question to ask, maybe walk us through the process, Betty, when you meet with these 3 dogs and 3 entrepreneurs and a dog kind of scenarios. How much do they know about financial modeling, and how do you help them? What's the process these people should learn from you?
Well, I'm going to answer a slightly different question than what he just asked. The first thing Naeem said that's really important is, do you have a business? And I've got this great idea I just invented. We're going to go into the bottled water business. Well, do you really understand the business and who else is out there and what the competitors are? So before you start building a financial model, you've got to figure out, can you make money at this? And can you make money long term, and does it pay off? Because some businesses are going to make money, but let's say you need to raise $100 million to make it work. Well, if you could do it on a $2 million budget, it's a great business. But that same business needing $100 million, unless you think you can get the money. I mean, imagine starting a competitor to Airbnb right now. They're entrenched in the market. It's going to take a lot more to get them out of there. So when you want to do a financial model, most folks coming into it have absolutely no clue. They've got a great idea. They're fantastic engineers. They're great marketers. They know how to bring a product to market, but they don't realize what it's going to cost. So the real first step, before you get too deep down in the weeds, is ask yourself, from a 30,000-foot level, is this a real business and can I make it work? And sometimes the answer is it doesn't matter. You have a social purpose to the company. And you say, as long as I don't lose too much money, or as long as I break even, I really want to do this great thing. I know a company that's doing, trying to get arsenic out of the water wells in India. And they say, we don't care if we make money. As long as we don't lose too much, look at the social good that we're doing. So figure out what your objective is, and then and only then can we deal with the financial modeling.
Steve, when you look at that people financial model, I'm only looking for, do they understand their unit economics? Do they understand their customer acquisition cost or churn rate? What are the metrics which you advise people they should be paying attention to, and what do you see from entrepreneurs?
All right, listen, this has become a pet peeve for me in a big way. I see probably 2,000 or 3,000 entrepreneurs in depth in the last 18 months. All of these business plans, of all of them, I would say 90% are made by engineering or software developer founders. For some reason, engineers are completely convinced that they can model anything, including the competition, and go to market and operating the company. Almost all of the budgets I see are completely off. They're not even close. I just want you guys to get it. You've got to get people who know what they're talking about to make the sales and marketing and operations budget. If you don't know, get someone who does. I just got a contract to say, please launch our product, a fintech product. All of the budget is about 60% too low. For example, they put $10,000 in for a show in Copenhagen. They say, can you get this to 9,000? Guys, the booth is 12,000. You asked for 6 people, it's $29,000. I just look it up. So mostly what happens is engineers make assumptions that are grossly wrong and throw them on these budgets. Then they come through looking for money. And by the way, the sales forecasts are not even close. You need to have somebody who sold what you're doing, look at it, and they'll usually scream and yell. Because I've got this other client that just asked me, look at this, we have $140 million guaranteed. Why? Because we modeled it properly, we paid for it, this model. It's only one problem, can't be sold like that in the US. It's more than 50% too high. And yet they're going out and using this for the basis of raising money. So get somebody on your team who knows sales and marketing or operations and ask them to look at your budget. Let them make the numbers. Don't let someone who's never done it make the numbers. First thing on your metrics.
Let me ask Roli, because Roli, you got a fancy MBA degree from Haas Business School in Berkeley. When you started your company, what kind of financial model did you create?
We didn't start with the financial model because really I think the step one is not to raise money. And at least I understood that very early, that I think you need to know what you want to do, and especially in the market that we are operating. It's not like an existing marketplace that you are just trying to optimize with technology. It is a market that is just building as we speak. So it's very difficult to come out with assumptions that everybody agrees with and that you yourself are confident about. So for us, it was really about spending the first year just figuring out how to play in that space. I think the only thing that kept us going was that, okay, there was a little bit of bootstrap money, which was enough to keep at least the 2 or 3 of us alive. But also, I think there was a good feedback from the customer. So we went actually after the customer instead of the investor. And when you do that, no financial model is necessary on day one.
Betty, do you agree?
Completely agree. So now let me answer the question. Otherwise, Naeem will never invite me back to anything here. So he mentioned a bunch of buzzwords. So let's talk about single user economics, because that's one of my favorites. And what that says is, look, Ravi's right. We don't know how many units anybody's going to buy. We don't know if anybody's even going to want the unit. But if you just sold one, what's the delta cost, the incremental cost to do that one guy, and what's the incremental revenue? So I'm just going to pick, I'm badged today as Dropbox, so we're going to make up numbers. These are not real numbers on Dropbox because I can't release confidential info. Besides, I haven't been there in the last 5 years since they outgrew me and went with a full-time CFO. But Dropbox sells for $9.99 a month for the basic package. That's pretty easy. Our delta revenue for one customer is $9.99. So now the question is, what does it cost to serve that one customer? Not what does the whole thing cost, but what's the incremental cost? We have the hosting and the customer service and the this and the that, but if we add just one guy, what does it cost? I'm going to make up the number. Let's pretend it's a nickel. I just invented the number because most SaaS companies have over an 80 or 90% margin. Okay, so let's pretend that out of the $9.99, we get to keep $9.50. I can do that in my head. Okay, we're making 49 cents a customer. Here's our fixed cost. How many of those 49-cent guys do we need in order to cover the fixed costs? So that's the simple, basic. You'd be amazed how many of Steve's clients and mine don't even know how to do single-user economics. So find one guy, delta cost, delta revenue, delta profit, and then start looking at your fixed costs. And don't forget little things like insurance, facilities. Copenhagen, you don't teleport to Copenhagen. You actually have to take an airplane and stay in hotels and get visas and all of that stuff. And so by the time you sit down with the model, in my opinion, the biggest thing is what's that next customer? And here's the reason. Most startups lose money. Most startups, when they sell, are still losing money. The guy that's buying you, the Cisco or the Microsoft or the Google or whoever's buying you, is not buying you because you're profitable. They're assuming they're going to take your customer base and layer it on top of their existing infrastructure. So all they care about is what's the incremental revenue you're going to bring, and is it going to be accretive? ACCRETIVE, accretive. Will it add to their bottom line? And if you're losing money on each customer, probably nobody wants to buy you, because all you're going to do is dilute them and they don't get anything. But if you're positive, even if you're not covering your fixed costs, they go, cool, I can add you in. My customer service cost is almost nothing. So adding you into customer service, I don't have to go buy a new building. I don't need a new CFO, a new CEO. So single user economics to me is king.
Yeah, unit economics is most important, but Steve, maybe you have any opinion about other key metrics such as churn rate or customer acquisition cost?
Absolutely. Customer acquisition costs vary from a few cents on a consumer basis, but it could be $50,000 or more if it's B2B sales. So you need to know, are you B2B and how you're going to reach those customers? I say take a piece of paper and draw out a flow chart and touch the points. Actually, you need to sell a real customer. So B2B enterprise, sell a customer, close the deal, and find out what your customer acquisition cost was. How did you get the lead? How did you follow up? And so on. If you're thinking about sales distributors or value-added resellers, a lot of people assume that these are almost free sales, and they're not. You will get zero sales. Zero. Unless you have a VP of sales, engineering support, and you go out and visit them and travel with them and give them the confidence that they can trust you. I ran sales around the entire world through all kinds of organizations. The reason my guys sell is because I traveled 100,000 miles a year and I visit them. That's why. If you don't do that, it won't happen. So cost of customer acquisition, the cost of your trade shows, you have to drill down and see how much everything costs, including the visas. You got to look down at real cost of the hotel, because you can't assume that the cost in San Diego is the same as New York City. All varies tremendously. All the flight tickets just went up. It's high season. You go to Europe, double the price. So look at those metrics, your travel, your salaries, real salaries. People coming from Europe or Asia underestimate U.S. salaries by a long ways. So you have to actually look at these metrics. So customer acquisition, and another one compared to long-term value of your customer. You need to map out what it takes when they come in and how often you will get orders from them and how you will support to get those orders. I have to map all this out before you figure out what your budget is.
So the key point here is that there are 3 or 4 metrics which each investors would want to know. Yes. And if you're not prepared, you haven't thought about it, and you're a deer in the headlight when they say, what's your customer acquisition cost, what's the churn rate, then right away you lose credibility. Now, let me ask you this question, Betty. By the way, you can start lining up if you have questions. If I'm the entrepreneur working on a business plan and want to need a financial model, what are the first 3 things I need to do? How do I get started on a financial model?
Well, the best thing with a financial model is I just say, sit down in an empty room and close your eyes and say to yourself, what do I, the CEO of the company, need to know, do I have a real business? I'm going to come back to, before you build the model, what's important is this a science project where we don't know if we're going to be able to build these solar rooftop things? I'm going to pick on you. We don't know if it's possible to build it for, I'm going to make up the number, $100 a square foot or whatever the number is. So I'm a science project. Well, if so, I've got to figure out engineering costs and spend a lot of time in the lab building software. Well, maybe it's a very easy product. It's the water. Well, now I have a problem with branding and how do people learn my name, and is it a distribution problem? So the first thing is to figure out what's the big nut you have to crack. Usually, you're lucky it's only one. It's either engineering's hard, everything else is easy, sales is hard, everything else is easy, or financing is hard. The rest is easy, but I don't have the money. If you have 2 or 3 of those that are problem children, it's going to be really hard to make your company work. You're better off if you only have one tough nut. And sit down on the financial model and start looking at that one tough nut. What does it take? What are the resources? Do I need people? Do I need money? Do I need equipment? Do I need partnerships? And literally start writing down what you need and figure out that you're going to have to go find everything. Maybe the deal is we have a great idea, but we need an engineer. Well, finding that right engineer that's going to leave a company where he's making or she's making $200,000 a year to come work at your startup where they're just going to be eating ramen noodles and you're going to pay them 3% equity, maybe you're not going to get the right person, and it's going to be hard finding that. So figure out what your scarce variables are, and then go to 20 of your closest friends that have done this before and ask them, what did I leave out? What did I forget? And then, at the risk of sounding like a plug, find somebody that's done it before and have them help you out on it. There's a lot of resources online, but they're probably not for your business. So ask yourself, what can go wrong? The answer is everything. What will it cost me if it goes wrong, and what can I do to minimize the chance of it going wrong? And by the way, be optimistic. That's why you're here. Hope for the best, but financial model, prepare for the worst. It takes twice as long and costs twice as much is kind of the rule of thumb.
Okay, well, let's go to our audience question, and then Roli will pull you in more. Let's hear from our first question.
My name's Ben. I'm with TiEcon, and you've touched on a lot of the details that can go into a financial model. But when I see companies come in, I see everything from essentially an empty spreadsheet to something that has way too much information. So when you're advising companies, when is enough? What's enough and what's too much?
That's a pretty broad question. Look, you gotta make this company go. You gotta get to revenue, you gotta get to your customer. When you're starting off, I would leave everything off this plane that doesn't need to go on the plane so it's light so you can get into the air before you run into the fence at the end of the runway, okay? Throw everything off you don't need. I see a lot of engineering-driven companies that wish to make the product so perfect with all these things, and you add too much to it. You gotta go out and touch the customer and get customer feedback, not engineering feedback. So throw everything off that doesn't do that, and after you get some customer acquisition, you can add to it, because then you start getting metrics, real metrics. Until then, to be honest, we are hallucinating.
Let me add to that. Let's pretend we're trying to figure out how many sales a salesperson can make. So I'm going to get a little ridiculous here. Okay, I'm a salesperson, and I can make 15 calls in a day, and of those 15 calls, 28% will call me back the first time, and of those 19% will call me back the second time, and of those 4% will give me an in-person meeting, of which 2% will close. I just have 8 variables, or however many I just did. And if you multiply them all down, the answer is, 1 out of 20 will work. If your model has those 8 variables with 8 different percents in them, you're going way too far, because we don't know anything. We're just starting off the company. So I would suggest keeping a very simple, high-level metrics, and then as the company evolves 3 months later, 6 months, a year down the road, you can add some more complexity. The other thing that's hysterical is when you get a business plan, and somebody gives it to you, and their projected revenues are $723,218.14. Suggest round everything to the nearest $1,000. It gives you a lot more credibility than when you see a model that's got pennies and even dollars in them. Because, heck, we don't even know to the nearest 100,000 what this is going to look like. I don't know if that answered your question. Keep it simple.
Roli, did you do a model, or what was your experience starting?
Yeah, so I'll go back to my initial comments. I'll just share what we did in the first year. We really went after the customer acquisition cost. We really wanted to know that to acquire a new customer in India for home or business, how much is it going to cost? Can we do it online? Do we need to actually send a person every time? How many times do we need to send a person? So that customer acquisition strategy was really important for us to figure out. And then the second thing was, yes, okay, even after you've signed up someone, considering it's a competitive environment, what kind of margin can you make on these? Because this is unlike a pure play SaaS thing. This could be just a one-time or two-time sale. So you need to be cognizant of the profitability on kind of day one. I mean, you don't have to make money, but you should know what you can potentially make. And to us, the third thing that was important in sort of the considering a business model around it is that if you try to scale this, okay, so I have a customer acquisition cost that's actually $10, just to share, and we make about, about $200 to $300 of gross margin profit on each customer, right? So that looks very healthy. And I guess the question is, at scale, can I continue to have the same low customer acquisition cost? And can I continue to actually have the same gross margin? And in that case, adding more people to the team and adding a lot more management actually just will add to how we can scale. So I think those things were very important for us to establish early that, we know this technology, what is it going to take to sell this in the market?
Let me add something to what Roli just said. When you're building the model, one of the things you have to ask yourself is, are you going to hire ahead of the curve or behind the curve?
Yeah.
And let me explain what I mean by that. We're growing really, really fast, and we're going to need lots of salespeople. They have to go out in the field. Well, what happens if we have more appointments and we don't have enough trained salespeople?
Right.
We're going to lose orders. On the other hand, if we hire the salespeople, because it takes, I'm making this up, 2 months to get them trained, we hire them ahead and there's no orders, they're going to sit around and do nothing. So one of the real big decisions you have to make is, how fast do you go for growth? Do you wait for the stuff and struggle to catch up? Or do you hire ahead? Part of that is, are you capital constrained or not? Part of it is also the market you're in. In some markets, you have to move fast. Think of like an Airbnb. You get there first. There's an advantage to being first. On other businesses, there's an advantage to being second and let the other guy make the mistakes.
Hi, I'm Prashant Honawali and I run engineering for a startup, LiveHive. My question is, how do you do the capital kind of company structure in terms of like potentially founders equity, employee purchase plan, investors equity, kind of like preferential shares? Like how do you put all that in place as you keep raising funds?
Well, there's two answers to that. One is, what do you put in the plan? And you put in the plan one line, and it says, I'm going to raise 10 million on this date and 2 million on that date. I think the question you're asking is, how do you allocate the capital?
Yeah, the cap table.
And what the real question is going to be, let's pretend there's 3 co-founders. And I'm going to pick the 3 of us here. And Roli's doing all the work, Steve raised all the money, and I just have all the connections. Do we get a third, a third, a third? Do we go half and half? Do we go 70-30? So one of the big things you have to decide is, how do you handle the founder equity of the actual people that are eating the ramen all the time? And generally even solves a lot of problems later on, but it may not be equitable and fair. It's whatever your 3 or 2 co-founders. By the way, it's very hard to get founded if you only have 1 co-founder. Really, people don't like that, so you're better off with 2 or 3. Besides, the more brains, the better. And then I'll share a cap table with Naeem that he can send out to the group. There's no answer here that's right. The rule of thumb, though, is when you finally get to the exit 2 years from now, 3 years, 5, 7 years down the road, the founders want to have a significant amount. So if you can keep 25 to 30 to 40% to the founders by the time you sell, that's great. But then you have to mentally go through the process of a first round and a second round and a third round in diluting. So there is no rule of thumb. Most people get common stock at the beginning. Your founders will buy their stock for, $1.95 or $2 or some token amount like that. And then as the rounds raise, we're going to hire our first engineer. Well, maybe he pays a penny a share. And then we're going to hire a second engineer. Maybe she pays 3 cents a share. And you try and ramp it up. And at some point, there's some rules in the U.S. that require you to get a third party to do the valuation. And they just have a giant Ouija board in the back and charge you $5,000 to write this big fancy report. And that's called a 409A. So once you get to a point where you're doing something real, you can't just make up the price anymore. You have to follow the rules. But do you give a new engineer 2% or 1% or half? And I'll send a chart to Naeem that'll help. There's no, you have to do it this way, but these are just some free guidelines.
Steve, any guidelines you want to share? And
Yes.
Roli, you may ask the same.
Okay, so starting where Betty started, those first 3, now this is what I would recommend. If you're going to be hiring people and giving them shares, psychologically I would do this next step. Founders, how much are you going to give to your whole team? So let's say that the whole team's going to end up with 20, or let's say 15% of all the shares. On your cap chart, put the 15% in now, even though you didn't hire them, set it aside now psychologically and psychologically accept that you just had a dilution. Don't hold on to this imaginary shares that now you don't want to give away because it's diluting you in the future. So do it first. Then take a bunch more and realize if you raise money, if you raise 2 million, then 5, then 20, you're going to be giving a large hunk out to investors. Everyone dilutes. That's life. Get over it. So I say psychologically do it on the first day and don't say, oh, I own all this company and now I'll give a little bit to her, a little bit to her, and now I just lost. Okay? Because nothing's going to happen by yourself. So right now I see guys struggling. Now, second part. The first team of managers that come in get relatively a substantial amount of shares, but after this, the drop-off is quite quick. Okay? So people that come in downstream are getting much, much, much less. Whereas you might have 10% of still owning after a share of equity coming in. Somebody else may be down at 0.5% or something or 0.25%. That's the way it goes when they come in later. There's way bias to the front who take, the people who carry the heavy load get the shares. Okay? So downstream, when the risk is down, those guys get much, much less. Don't even talk in percentages.
Yeah.
Do not talk in percentages. Mr. or Miss Engineer, you're getting 100,000 shares. That might be 1/10 of 1%. Yeah. So it's 100,000. You cannot be given around all these big percentages 3 levels down. You'll be out of equity. Okay? So It's way biased to the front, drops off rather quickly, but make sure that people who are critical are going to stay with you, and they always vest, including you. As soon as money comes in, even though you 100% owned, the investors are going to say you are now going to be getting money or getting the shares over time. Okay, because if you quit tomorrow, you can't take all your shares. So that's protection.
Roli, what did you do?
Yeah, our idea was to keep it as simple as possible. I had started the company a few months before my co-founder joined, so we are almost equal, but just there's a slight difference. And we both agreed to it. I think it's just what you do across the table where both the parties are happy and they feel like, both of them won. I think that is point one. But I did want to just focus on Steve's point on the psychological aspect of this equity cap table in the beginning. What we do is, and I've seen myself actually go through this a little bit, is that you just get so tied with those numbers, like it's 50-50 or 60-40, and the issue is you think that right now there's a big journey between when you are zero, which is where you are when you're co-founding, versus when you are, let's say, $100 million or $1 billion enterprise. You are sitting at the table and then suddenly you start imagining yourself like 7 years down the line when you might be $1 billion, and you almost ignore everything that has to go in the middle to take you there. So I think these numbers can just be, they can weigh you down psychologically in the beginning, and I think you should just be mindful that they are just numbers. And I think the important thing is that the co-founding team should be just really happy that they are all working together, and that together only you can actually get there. Otherwise, it's just a number. It's a 50% of nothing, and that will end up being nothing after like 5 years of work.
Said another way, the difference small, 50%, 60%. By the time you exit, it'll be like 5.2% versus 5.8%.
That's right.
It doesn't matter.
Yeah.
Just quit fighting about that. If you're fighting about that, this conversation is taking more than 30 minutes, you have other problems.
Hi, my name is Alluri Raju. I'm co-founder for Sales Canary. So this question is beyond the founders. So when you bring in investors for the seed, Series A, B, C, what is a typical benchmark of equity do you give in those rounds?
It's not what you give, it's what they demand. Right. And most VCs are going to want 15 to 20% of the company. They'll want more, but if they don't get under at least 15, they usually don't invest as a lead. Now, if you're getting friends and family, your Uncle Charlie and your Aunt Mary, they'll do what you want. But if you go to somebody on Sand Hill Road, the typical number they want is 15 to 20. So let's say you're raising $3 million. Well, that's easy. 3 million divided by 0.15 or 0.2, you're there. So sometimes you say to yourself, well, that's not enough. Maybe I rather raise 5, even if I only need 2, for 2 reasons. One is it never hurts to have more money. And secondly, no matter what they give me, they're going to want 15 to 20 anyway. So I may as well get the biggest darn number I can get if I'm going to give up 20%.
Right.
Steve, any other?
Yes, on your seed round, around here, you're probably talking to angels. So if you're talking to angels at $1 million, you got to be looking at a pre-money, this is how it works. Pre-money value that you agree on, let's say it's $4 million, and you get $1 million, that's 1 plus 4 equals 5. Final value's 5. You gave them they gave you $1 million, 1 over 5 is 20%. So there you are. How do you get $5 million? Well, part of it is art and science, because officially what you do is a forecast out until you break even. That might be 3.5, 4 years. Do you do a discounted cash flow back? This is a kind of a sanity check. And if you do this properly, and you have to take a discount rate, the higher the risk, the higher the discount. So you come back and you say, yeah, this looks like about $4.5 to $6 to $7 million. So you get $1 million, it's $1 million over that number, that's the percentage. Now, a lot of guys are going to tell you, look, you're early stage, you don't have revenue, I'm taking massive risk. I'm not doing this for less than 20% at the seed round. So if you want that money, take it. Most engineers and, well, startup guys, not just engineers, don't actually, in my opinion, appreciate the value of that first $1 million. That is the most expensive money you will ever get, and I'm not kidding. I have rules. You do not eat in restaurants with white tablecloths when you're in the seed round. You don't buy fancy coffee with whipped cream. Those days are over until you make your own money. So that first $1 million is really expensive. Got it?
And what most people are doing these days, the world has changed in the last 5 years. Generally now they expect the first $500,000, you got it on your own. Yep. It's your Aunt Martha, your Uncle Charlie, and your American Express card. So they're expecting you to work for ramen until you get something. You generally these days don't get a PowerPoint where you get funding. Now, there's what I call flavor of the week. It depends what you're in. You're in augmented reality for the Internet of Things and a social network. Ooh, I had 3 buzzwords. I call that buzzword compliant. You have a buzzword compliant business plan. You're more likely to get funding because that discounted net present value cash flow, that's how it works in B school. In reality, it's supply and demand. And if you're in the flavor of the week, you've got a better demand and you'll get a higher price. If you came out right now and you tried to do what Zynga did 10 years ago with Farmville, your value is going to be next to nothing. But man, when Zynga went out, it was hot stuff. Yeah. So it just depends. Are you buzzword compliant and what are people doing? And if there was a really good exit in your space, you're going to get a higher value than if the last 3 that went out just flopped.
Hi, this is Sri Palepu. I'm co-owner of Veridic Solutions, which is an educational company. My question is not more on a startup, but more like a scale-up or a fold-up. We've been in business for 10 years in EdTech, which is not sexy in this room.
Yes, it is. It's flavor of the week.
Okay. So, I mean, we, at peak time, we had about 450 schools enrolled in our K-12 program, and a lot of teachers were using. But for last few years, we are seeing a lot of attrition in the schools. One, because of the funds from the government dwindling, and then there is a
express your thoughts in the form of a question.
Yeah.
Sounds like a question.
At what time do we think of folding up our, how do we scale up if not when you are facing a big behemoth in the competition?
Well, we don't think about exiting. I think we don't have that plan B. I mean, the idea is to not fail. But in a crowded market, I think, I was by myself for about a year before I got my first employee in the founding engineer. And the reason was that I knew that the space that we were operating in has low barriers to entry. So how do you actually have a play there? And I think that has to be day one planning, that how do you differentiate yourself in a crowded market.
Won't you say that every large behemoth have an underbelly of the beast? I mean, even Google, the best idea they've come up on social is Google+.
Right.
So there's an underbelly of the beast.
Yes.
So this is how you can go after the behemoth. They all have an underbelly. Soft spot where you can attack.
Well, it depends if you're going in a market that Google is in. But like I know many friends in the EdTech space, it's a very distributed space. So there isn't any one big
there's no 800-pound gorilla, that's true.
Yeah. So, but it's still very difficult to operate. And in solar also, you'll see all the big names are not doing very well in US, but the small guys are doing well. So now we are sort of moving to a point that we actually are going to be supporting a lot more of the things that the small guys can't do. So you have to figure out how, with scale and technology, if that is your interest, you still continue to add value in that space. Because otherwise, I think it becomes an unexciting business. I think that's the problem, and that's one thing that we want to be really mindful of ourselves, is that we don't want to become a small business, and but the space is very big. So it's really, I think that's where all our degrees and our acumen should come in.
My name is Deepal Mehta. I had a question regarding financial modeling, especially when you are very new. When to hire, how much to hire. Is there a guideline on the financial strategy, right? Do you want to reach break even in 1 year, 1.5 years? Do you have an exit? So you're just investing and you have an exit in mind. How do you play that part?
I'm going to give a very flippant answer. Without looking at your model, I know exactly what that's going to look like. The last page is going to look like a hockey stick. They all look the same. Everybody loses money for the first 2 or 3 years, and in the 4th, 5th, and 6th years, it becomes immensely profitable and gets 15% market share and becomes a billion-dollar company. So every VC knows that's exactly what your business plan is going to look like, so they ignore it. I'm going to say it again, they ignore all this hard work that you do for the financial plan. But let me tell you what's important. The journey is what really counts. Asking yourself the questions, how do I do this? When do I this? What happens if this? When do I hire? How much do I pay them? Should I be a freemium model, not a freemium model? Do I charge up front? Do I charge a SaaS? The VCs are looking, have you thought through the questions?
Yeah, the financial assumption you made and how did you validate them is the confidence builder.
Right, and so the answer isn't the answer. The purpose of the financial plan is not that one slide that everybody knows. It's asking yourself those hard questions and saying, is my co-founding VP of engineering that's sitting right here going to be able to survive 3 years? No, she's going to be great for the first 1.5 years, and then we're going to outgrow her. Just like my companies that outgrow me, I'm 1 day a week, they outgrow me, and they need somebody better. So people are stage specific. And so you have to ask yourself, all those hard questions.
Engineers with good ideas, take your idea, put it on a PPT, get a prototype, and go to a customer and sell it from the very beginning.
Before you make it.
Before you make it. Go visit. Now, you guys, everyone tells me you can't do this. I've done it several times. I have done it. So I'm taking my own medicine.
Me too.
I took PPT over to Intel, right up the street. They looked at this, they said, "Are you nuts? We do need this, but who are you?" Well, I got to the second meeting, the third meeting. Then they said, "All right, can you show us?" We showed them this junky stuff in our lab, and we worked with them for a year. I ended up with $1 million order. That became a product line. I sold $150 million of this stuff around the world. It's fantastic. Investors said, "How do we know this works?" Because Mr. Intel bought it, that's how.
But was what they bought what you showed them the first time, or based on their feedback you changed the product?
Oh, of course we changed the product. You know how we changed it? According to the need of the customer. Nobody on our team made up anything. Everything came from the customer's mouth. And sometimes we argued and said, "You guys, physically that's not going to work very well, here's why," but we did it together, and we didn't do any engineering that the customer wasn't going to pay for. And then when I got the order, it started like this. You pay a down payment of 15%. I had $150K on the order. I got 40% to pay for the parts about 4 months later. So they actually financed it. So get this. I got the customer, Mr. Big Customer, to finance this fancy-dancy machine. After that, I said, "Wow, this is the way to go." I sold enterprise software for billing by selling this tiny little thing that was too small but solved one little niche problem that the big guys didn't have. And not only that, they said, "Will you come and visit us every Friday and listen to our users?" I said, "Yes, I will." The big guys won't do that. So my customer in the staffing business designed the product for me, with me, and we built it every 2 weeks and released it.
And he didn't give up any equity for that.
Exactly right. And you know what happened is the CEO of that company began to get a kick out of my visits on Friday. He used to laugh and he goes, "You're still coming back to take?" His staff beat me up every single Friday with complaints. But after 6 months, they beat me up so much, I said, "Okay, if you don't want the product, I'll give you a couple months to transition out." And they said, "Are you kidding? We invested all this time with you. This is the perfect product for us. You cannot leave now."
Yeah, hi. My name is Ravi, and I'm a founder of Audit Prodigy, which is an operations excellence tool. Pretty old-fashioned, but there's a lot of market for it. And we took your advice, 16 months of ramen, and we sold our first product. My question to you is, how alert are they? When do they finally figure out something is coming at them versus while they're still sleeping, you're making progress, and you get them by the time they know you're there already?
Okay, look, when you got that small company that I'm talking about, you got to, once you get that niche, you got to go work that niche and sell, sell, sell. Now look what happened to Kodak, the world's best photography, and they just couldn't let go. They couldn't go digital. Lots of companies do this because once you're vested, and it can happen to you too, because once you make 10 or 20, $30 million some way, you want to protect it. And that's how people become vulnerable. Once you go into protection mode, you're vulnerable. You got to be realizing, as Betty said, the game changes. Things change. So you've got it. The only way you know is that you visit your customers all the time, particularly B2B. There's none of this stuff. If the CEO doesn't visit customers, it's already over. You have to go listen.
In your financial modeling, you have a list of assumptions. So I think what he was asking was, so do you make an assumption that the competition or those giants, they're going to move somewhere in that timeline? So do you make an assumption that that's a risk factor?
Yes. Well, most startups aren't going to get 20% market share within the first couple of years. Usually the problem isn't that the market's not big enough. If it isn't, you've got the wrong market and you're in the wrong place. Usually the question is, am I going to get 2 million or 5 million or 10 million in sales in a market that's $400 million? So the answer is it doesn't really matter so much at the beginning what the big guys are doing. And I know that sounds crazy, because if you're doing something really good and unique and different, it'll take Kodak a while to move into digital. It might take them 10 years or 2 years, but the big guys don't move so fast. It's like the Titanic. So you want to come in like Muhammad Ali. You want to come in and jab and carve your little area out. And frankly, you want the big guys to notice you because you want them to buy you. Very few people in this room are going to do an IPO, guys. 99% companies either go bust or get bought, or they're kind of coasting along as the wounded dead. But you really want these big guys to sit up and notice after you've got enough there that there's something worth buying. right?
I just wanted to add a little bit to this. If it is a B2C play, I think customer engagement and branding is like table stakes on day one. And I think even for us, we had to decide whether we want to go to B2C or B2B, because the go-to-market strategy is completely different in terms of the people needed and the engagement strategy. And I think if you have a brand, there's always that leverage that you wouldn't have if you're just like a tool behind the scenes kind of a. So I think you're a lot more vulnerable that way.
Thank you for coming. Thank you, panelists. Thanks for your attention.
Thank you.
4 minutes to switch.